The declining balance depreciation method is a form of accelerated depreciation, which means companies that use this method will experience a greatest amount of depreciation during the first few years of the asset's use. For accelerated depreciation, basically what you are doing is you are depreciating by a multiple of a straight line rate. The most common by far is double straight line, which they refer to as the double declining balance method. So if an asset has a useful life of 5 years, well, under straight line depreciation you would take away an equal portion each year. So 1/5 would go away each year. That's 20%. But if you're going to use the double declining rate method, you would use double the straight line rate. So 20% times 2, 40% would be the amount that you used. We're going to start on January 1st, 2018, when L Drain Enterprises purchases a machine with a useful life of 5 years for $42,000, and it has a residual value of $4,000. For the sake of ease here, we're going to do annual adjustments, so we're only going to record one depreciation adjustment per year. The reason being is because doing this monthly for a multi-year asset means you would have to do one for each month over its life. In this case, we have 5 years, it'd be 12 months per year. You'd have a 60-line table you would have to fill out. Let's keep this simple and just do it annually. So, how do we do this? Well, let's start at the first date that we are going to make our depreciation adjustment. So on December 31st, 2018, the beginning book value of this piece of equipment, this machine, is going to be $42,000. It's the first column that we fill in this table. And please note that is the book value. Right? We bought this for $42,000. It wouldn't have any depreciation before this adjustment, so our books would be saying that it's worth $42,000. Do not subtract the residual value. If you do, it's like mathematically impossible to finish the table. So start with the historical cost for your beginning book value, which was $42,000. This machine has a useful life of 5 years, so 1/5 of that would be 20%, but we're going to use the double declining balance rate, which is double straight line, so that would be 40%. 1 divided by 5 times 2. And now we can take our beginning book value, multiply it by our double declining balance rate, and that is going to equal our depreciation expense. So during 2018, at the end of the year, L Drain Enterprises is going to record a depreciation expense of $16,800. Since this is the first year this asset was used, that means the accumulated depreciation on this asset will also be $16,800. Now we need to figure out what the book value will be at the end of the year. Well, what is book value? It's historical cost minus accumulated depreciation. So $42,000 historical cost minus our $16,800 of accumulated depreciation at this point means that this piece of equipment is going to have a book value of $25,200 at the end of 2018. Moving on to 2019. If we ended 2018 with a book value of $25,200, well, we're going to begin 2019 with that same amount. So whatever your ending book value is for 1 year becomes your beginning book value for the next year. Our double declining rate doesn't change, it's still 40%, and 40% of our new beginning book value of $25,200 is going to be $10,080. We had $16,800 of accumulated depreciation at the end of 2018. We're adding another $10,080 now, which means our accumulated depreciation account for this particular machine will increase to $26,880. And our ending book value will be our $42,000 historical cost minus $26,880 in accumulated depreciation, which is $15,120. Since that's what we ended 2019 with, it's what we're going to begin 2020 with. And we take that, we multiply it by our double declining balance rate of 40%, we come up with $6,048. We add that $6,048 current year depreciation expense to our last known balance of accumulated depreciation, increasing our accumulated depreciation to $32,928. And when we subtract that $32,928 of accumulated depreciation from our historical cost of $42,000, the book value of this machine will be $9,072 at the end of 2020. Moving on to 2021, we are going to take our beginning book value of $9,072. Multiply it by the double declining rate to come up with $3,629 of current year depreciation expense. Add that to our last known balance of accumulated depreciation, and we're going to have $36,557. And then when we subtract that from our historical cost of $42,000, the machine will have a value of $5,443 on our books at the end of our 2021 year. And moving on to our fifth and final year of this asset's useful life, we're going to start with a $5,443 beginning book value, multiply it by the double declining rate of 40%, and we are going to come up with a depreciation expense of $2,178. Add that to our accumulated depreciation, and we're going to have $38,735 of accumulated depreciation. Subtract that from our historical cost of $42,000, and we're going to end up with a book value of $3,265. And now we have a problem. Our problem being, we were saying at the beginning of this that our residual value was $4,000. Well, we have a book value that's below our residual. We can't have that. We can't have this asset on our books for a value that's less than what we said in the beginning it was going to be worth at the end of its life. So what do? Let's go and strike this straight out and make a new line for 2022. We still have the same beginning book value of $5,443, but now instead of doing the calculations, the double declining balance rate of 40%, we're going to do what they say, plug. We're going to go and we're going to take the number that's going to reduce us from our beginning book value at this year's beginning, $5,443, down to our $4,000 residual value, and that is $1,443. And when we record a depreciation expense of $1,443, we're going to add it to our existing accumulated depreciation of $36,557 to come up with $38,000 on the dot. And when we subtract that $38,000 in accumulated depreciation from the $42,000 historical cost, we come up with $4,000, which is exactly our residual value. So for an amortization table, keeping track of all of the depreciation amounts you're going to record each year using this double declining method, it never works out perfectly at the end. To the very last line, you're going to have to what they call plug. As soon as you hit a number that is below your residual value, you know you can't record the depreciation expense that you came up with in the first place. What you're going to have to do is come up with the number that takes you from your current book value at the beginning of the period down to your residual amount. Recording a journal entry after your amortization table done is easy. At the end of 2018, we would go and we would see that our depreciation expense for the year is $16,800, and we would record it like we always record depreciation. We would have a debit to depreciation expense and a credit to accumulated depreciation. And then each year in the future, we already have that number. So for 2019, we record $10,080. For 2020, we record $6,048. For 2021, we record $3,629, so on and so forth. So if you're going to use this method, the best thing to do is to set up your amortization table at the beginning of the asset's life, and then you can just go and look up what your depreciation expense is going to be each year.